Introduction to venture capital, exploring financing options and growth strategies for startups. Presentation overview. What is venture capital? Venture capital is a type of private equity financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. How venture capital works. Venture capital works by providing funding to startups and small businesses that have high growth potential. The process typically involves multiple rounds of funding, with investors providing capital in exchange for an ownership stake in the company. Venture capital exit strategies. Venture capital exit strategies involve ways in which investors can exit their investment in the startup, such as through acquisition or initial public offering, IPO. Advantages and disadvantages of venture capital. Venture capital has advantages and disadvantages for both investors and startups. While it can provide access to capital and expertise, it also involves giving up some control and ownership of the company. What is venture capital? Definition and characteristics. Venture capital is an investment in early stage companies that have the potential for high growth. It is a high risk, high reward form of financing that requires a long term investment horizon. Importance of venture capital. Venture capital is an important source of funding for startups, providing not only financial support, but also expertise, mentoring, and access to networks. High risk, high reward. High risk, high reward financing. Venture capital is high risk, high reward financing that offers extraordinary returns to investors who are willing to take on greater risks. Risks and rewards of venture capital. We will explore the risks and rewards of venture capital, including the potential for extraordinary returns and the importance of diversification to minimize risk. Long-term investment. Venture capital is a type of long-term investment that involves providing capital to startups and early-stage companies that have the potential for high growth. How does venture capital work? Funding stages. Venture capital involves multiple funding stages, including seed funding, early-stage funding, and late-stage funding. Each stage comes with its own unique set of challenges and opportunities for entrepreneurs and investors. Equity financing. Venture capitalists provide equity financing to startups in exchange for a share of ownership. This allows startups to raise large sums of money without taking on debt, but also dilutes the ownership stake of the founding team. Due diligence. Venture capitalists conduct due diligence on startups to assess the viability and potential for success. This involves researching the market, evaluating the team, and analyzing the product or service. Exit strategies. Venture capitalists typically have a specific exit strategy in mind when investing in a startup. This can involve going public through an IPO, merging with another company, or being acquired. Funding process. Seed funding. Seed funding is the earliest stage of venture capital funding and is typically provided by the founders, family, friends, and angel investors. It is used to validate an idea, build a prototype, and conduct market research. Angel funding. Angel funding is typically the next stage of venture capital funding and is provided by wealthy individuals or groups who invest in the startups in exchange for equity. Angel investors provide not only capital, but also mentorship and networking opportunities. Venture capital funding. Venture capital funding is the last stage of venture capital funding and is provided by institutional investors such as VC firms, hedge funds, and corporate venture capitalists. This type of funding is used for selling the business and expanding into new markets. Equity financing. Equity financing has several advantages and disadvantages. Advantages include access to capital, network, and expertise of investors, while disadvantages include loss of ownership and control of the business. The entrepreneur also has to share profits with investors and follow their demands and restrictions. Due diligence. Introduction to due diligence. Due diligence is a comprehensive investigation of a potential investment that involves investors, that helps investors evaluate the risks and benefits. It is an essential part of the venture capital process. The due diligence process. The due diligence process typically involves a thorough review of the company's financial statements, legal and regulatory compliance, management team, market potential, and other relevant factors. Types of information looked for. Investors look for a wide range of information during due diligence, including finance and accounting records, legal documents, market research, and all potential risks that could impact the investment. Exit strategies. IPOs. An IPO or initial public offering is a process by which a private company becomes a public company by selling shares of its stocks to the public for the first time. This is a common exit strategy for venture capitalists and private equity investors. Acquisitions. An acquisition is a process by which one company buys another company. This is a common exit strategy for investors who are looking to sell their stake in a company. The acquiring company usually offers a premium for the target company to gain control of its assets or intellectual property. The pros and cons of venture capital. Advantages of venture capital financing. Venture capital financing can provide entrepreneurs with access to significant amounts of capital and expertise, allowing them to grow their businesses quickly and efficiently. Disadvantages of venture capital financing. Venture capital financing often involves giving up a significant amount of control and equity in the business, as well as being subject to high levels of scrutiny and pressure from investors. Access to capital and expertise. Venture capital provides startups with access to capital and expertise, helping them grow and succeed. Loss of control. A major drawback of venture capital is the loss of control that comes with equity financing. Business owners may have to give up a significant portion of ownership and control of the business to investors. High failure rate. High failure rate of startups. One of the main drawbacks of venture capital is the high failure rate of startups. Most startups fail within the first few years of operation due to a variety of factors such as poor management, lack of funding, and market conditions. Risk and reward of venture capital. Venture capital is a high risk, high reward type of investment that can yield significant returns for investors, but also comes with a risk of losing money. It is important to carefully weigh the risks and rewards before investing in a venture. Importance of diversification. Diversification is key to managing risk in venture capital investments. By spreading investments across multiple ventures, investors can minimize the impact of losses from individual investments and improve their chances of overall success. Conclusion. Venture capital can be a powerful tool for entrepreneurs looking to grow their businesses. By providing funding, mentorship, and access to networks, venture capitalists can help entrepreneurs realize their vision and achieve success. Thank you.